Okay, positive covenant and negative covenant. This is an important one. Can you see now screen?
Yes.
Yes, sir.
Okay. So now I'm supposed to begin from here, right? Fixed income cash flows and types. Okay.
So I just have one question from the portal questions actually. Should I send it on the group? Because I've taken like a screenshot.
Yeah, send it. Even derivative doubts are pending, right? Okay,
Yeah, few
doubts are
modules.
pending. Yeah.
So here in the question, it mentions that the notes are secured. So that means it will be backed by some asset, right? And the repayment will be done from the cash flow generated from that asset. But then
Huh.
it's saying it's option C.
So this is the question.
Yeah.
This is from website you have taken. Website questions.
Yes.
This is there in the module, like
Okay.
quizzes,
Okay,
practice
fine.
quiz. Even I didn't get this one.
Okay. So the question is, which of the following statements best describes the sources of repayment for the Antillas AG floating rate? Since the notes are secured by Antillas, the floating rate notes would be considered asset-backed securities. Uh, so the correct answer is C, they are saying. The Antillas AG notes rely only on the operating cash flows of the firm as their primary source for interest and principal payment. Which of the following best describes the sources of payment? So that initial part is missing, related to micro machining and metal 3D printing technology, and derives its revenue through royalties and consultation. Antillas recently issued the following debt instruments. Antillas AG T plus 5 business days, uh, T plus 5 business days, 4 years from settlement date.
Royalties, like does it comes under like operating cash flows,
Yeah,
royalties and
commencing.
consultation services?
Yes,
So
commencing 3 months from settlement to be paid quarterly within 5 years. The notes are secured. Okay, and unsubordinated obligations of entities and will rank pari passu with all other secured and unsubordinated indebtedness. Okay. So Antilla's settlement date 4 years from settlement. Euro 250 MRR commencing 3 months. The notes are secured and unsubordinated obligations. Now the question is, which of the following statement best describe the sources of repayment? Oh, sources of repayment. So you mentioned secured backed by. See, this is at the time of default. That time only you will sell the assets, right?
Yeah.
So the
So
question is
I
not about at the
okay.
time of default. The question is generally how will you repay the interest rates? Which of the following
Okay.
statement best describes the sources of repayment for the Antilla's AG floating rate? You assumed that it is for default.
Yeah, yeah.
Okay, so you thought, or it should be like, if it is mortgage backed securities, then you can say it is secured by home loans and the home loan is the source to make the payment, because through home loan they actually get the payment, right? Interest.
Right.
Here there is no such thing, right? Here it's a normal business. What is that normal? Some 3D printing something they are saying. So that means normal. So that is only the source for them to give back the money, no? In mortgage backed securities, home loan is the source.
Yes.
So there both are matching, home loan as well as the business. Here 3D printing is not matching, right? That is not giving you any fixed return. So that will come under operations.
Okay.
Is it okay?
So if it's mortgage back, then only it
Then
will
it
be
is okay. Then it is
generating.
fine.
Okay.
Yeah.
So what's the difference between B and C? Like this in sole source.
Ah,
Um,
notes rely on the operating cash flow of the firm as their sole source for interest and principal payments. Which are the following statements? No, that is not the sole source. Best describes the sources of repayment for and so worst to worst case they will have to sell the assets. That is not the only one, right? Majorly they will be dependent on the operations, but worst to worst case they will be dependent on the assets backed by the floating rate bonds.
okay.
Okay,
Okay, sir.
that's it.
So I have two more doubts.
Okay, you send it then.
Okay, just a minute. I've sent it. So
In WhatsApp you have sent.
yes.
So this is the question. Third one, Antilla's AG issuer specific credit spread rises by 25 basis points per annum 1 year after the FRN issues. Okay, credit spread, issuer specific. Okay. Which of the following best describes how Antilla's AG FRN coupon would change as a result? Coupon will not change. Coupon will remain unchanged.
Unchanged.
Why would coupon change? Whatever they have promised, that only they are supposed to pay.
Okay.
Is it okay?
Yes, sir.
The ratings, like imagine you have taken loan from somebody and promised to pay 10%. Now, after agreement happens, suddenly you are facing some big problem. So does that mean now you will pay more interest?
No, like it is fixed.
Or less interest? Nothing. It is fixed. That much only you are supposed to pay. Okay, that's it.
The fourth one, sir.
Fourth one. Fourth one is a calculation, right?
Yeah.
Calculate the value of Antilla's payments to bondholders on the maturity date if the MRR is 0.25% per annum for the final interest period. Calculate the value of Antilla's payment to bondholders on the maturity date if the MRR is 0.25 for the final interest. Okay. For the final interest. So final interest will be MRR is 0.25, and what was the quoted margin? Quoted margin was
So interest was MRR plus 250 basis point per annum.
quoted margin was 250 basis points. Okay,
But we
so
don't know the MRR, right?
the MRR they have given in that question that you sent.
0.25. But that is
0.25
only
plus
for one period, right?
per annum. Wait,
Just
it is being paid quarterly. See, this is
So it will be MRR plus 2.5%.
yes.
Basis point.
MRR is what? How much you said?
0.25.
0.25, right? Plus 2.5.
Yeah.
2.5 basis points.
The
200,
2.75.
2.75 divided by 2.75% divided by 4 because it is quarterly being paid.
So that's why I got wrong answer. I'll just try it, suggestion.
How much money did they borrow?
It's 250 million.
250 million.
So 0.25% plus 2.5% equal to that amount divided by 4. That percentage multiplied by 250 million.
I'm using the PV thing, the NIY PMT.
No. Wait, I'll do this now.
So 16 N will be 16, right? 4
Wait.
years and
No. Wait. See, 0.25% is the MRR.
yeah.
Plus quoted margin. It is called quoted margin, which is 250 basis
250
points.
basis point. 2.5.
We have not done anyways this kind of sums. So once we do, then only you will understand. Plus quoted margin is
2.5.
okay. Quoted margin is
2.5.
2.5%. So total comes to what?
2.75.
2.75% divided by 4. So that comes to
It is 0.6875.
0.6875%
Yeah.
of what is the principal amount?
250.
250 million, correct?
Yeah, 250 million. Doing it. It's 1,718,750. The
So is
first
it
one.
matching?
Yeah.
But
Yeah.
it's option B. So
Yeah, the
and
answer is B.
It's not matching.
no, because it's at the final repayment, right? So we'll have to add.
Add the principal amount also along with
Yeah.
that. Yeah.
So it's coming to option B only.
So, okay, how much is this amount coming to?
1,700,000. I'll calculate it.
Hmm?
Just a minute.
So I think it's MRR plus quoted margin into the principal amount. Then we divide by 4 and then we have to add the principal amount again. Then it's coming to option B.
Correct only. So how much is this amount?
So this
Plus
amount
you add
is
principal.
1,718,750.
1,718,700.
18,000 and 750.
Now
Yeah,
plus
250.
2.5 million you have to add because that is the principal amount.
Yeah, 250, sir. 250 million.
250 million.
Yeah, so that's the B option.
250 million.
Yeah,
So when you add, how much it comes to? Option B.
250. Yeah, option B.
So that is matching with the answer.
Yes.
So like even if we divide it first or later, like we'll arrive at the same answer. Right?
Yeah.
So like if we do 2.75% into 250 million by 4, then also we'll get the same answer. That is 1,718,750.
If you take 2.75 percentage of 250,000, 250 million, and whatever answer you get, you divide by 4. You will get this number only.
Yeah, yeah. Yes.
There's one more sum which I didn't get, but I don't think we've done that yet.
We have not done any sum, in fact, right? We have just done theoretically only.
Yeah, like this is there in the first module itself. So that's why I did it. I tried.
Okay.
Yeah.
Okay. We'll do the sum, then you will get to know all this. Okay.
Okay.
Okay. Now fixed income cash flows and types. Now bullet structure and coupons. Bullet structure means normal principal is backed by a single payment. A typical bond has a bullet structure where principal is paid back in the single payment at maturity, periodic across the life of the bond, are purely interest. That is called bullet. So bullet means what? Like 4-year bond, 1, 2, 0, 1, 2, 3, 4. So here imagine 10 percentage interest. So they are paying 100. Face value is 1000. Coupon is 10 percentage. So company is paying 100, 10 percentage of 1000, 100 and then 100 and then 1000. Okay. So this is called bullet style, where lump sum will be paid at the end and periodic interest will be paid. It's called bullet structure. Okay. Then there is something called balloon also. Balloon payment means like zero coupon bond. No, directly they are paying at the end balloon amount. So this is called balloon. Huge lump sum amount paid at the time of maturity. That's called balloon. And this is bullet structure. Then amortizing loan. So amortizing loan means what? Say for example, you have taken loan. Okay, 10,000 rupees loan you have taken. So loan taken 10,000. And interest is 10 percentage to be paid in, let's say, 5 years. 5 years as in once in a year you are paying. Okay, practically you will be paying every month, but you will get sums like you are paying yearly. Okay, so yearly 5 years. So now if I convert this into amortizing structure, how it will happen is, amortizing means periodically you are paying. That is amortization. Okay, so now the loan is what? How much? 10,000. And for that we will use this time value of money function also. How much will you pay every year? So right, 5 years you are supposed to pay, and interest is 10 percentage. Present value right now you have 10,000. You received it. So I'm keeping in plus because you have received this cash. Payment is what we need to find out. And at the end, Once you pay all, see, in amortizing, you are paying principal as well as interest together, like you are paying home loan. In home loan, what happens? Principal plus interest both will come together. Same way, that is amortizing only. In fact, home loan, the way you pay EMI, that is amortizing. So now you calculate how much is the payment coming to. How much is the payment coming to?
2673.97.
2673 point.
37, sorry, 2637.97.
This is the payment. Okay. So now that means you have to pay this much. So this is the payment. So payment is 2637. This is for year one. Year one. So 2637.97. So let me round up to 2638. Okay. And what is the interest amongst this? See, interest is 10% you are supposed to pay. So 10% of this amount, or
1000.
yeah, or wait, I'll keep this. I'll keep interest column left hand side. Interest, payment, principal repaid. Okay. So interest you are supposed to pay 10%. So that is 1000. Payment, but you paid how much? 2638. So remaining, that means remaining is what? 1638. That is the principal repaid. Is this step fine? Have you understood
Yes,
this
sir.
one?
Yes.
Okay. So principal repaid. So remaining outstanding loan. Outstanding loan will be what? You had initially 10,000. You have paid minus 1638. Then just calculate how much is the remaining. Is there outstanding remaining or closing
83
balance?
8362.
Closing balance of outstanding loan. So next year that will be the opening
We'll
8362.
deduct only the principal
Yes, only
payments,
the
right?
principal. Yeah. And then from you have to pay 10% interest. That comes to 836. Okay.
Yeah.
At point two, I'm ignoring.
Okay.
But you will pay 2638. So what is the remaining amount, which is principal? So 2638 minus 836. How much calculate?
1802.
1802. So you have repaid this much of principal. So out of 8362,
Yeah.
you have repaid 1802. Just calculate now.
6560.
Huh. Now 6560 into 10% will be
65.
656. And then payment will be 2638. Repaid is the difference. So 656 minus
1982.
1982. So from 6560, you will repay 1982.
4578.
4578. So here 4578 into 10% will be
458.
457 or 58. You take, it is fine. So, but you will pay 2638. So the difference is how much?
2180.
Huh?
2180.
2180. So
Yes.
4578 minus 2180. How much?
That is 2398. Sorry.
2398. 2398 into 10% is 239 or 240 you take. So 2638. Now what is the difference?
2398. 0.
2398. So 2398 minus 2398 equal to 0. So after 5 years, zero balance. Loan paid. Is it okay?
Yes.
Yes, sir.
Yeah. So this is called amortization. Like EMI calculations only. Okay. Then this is fully amortized till the end. Now what if it is partially amortized? Okay, partially amortized means what? Say for example, first 3 years it is amortized. After that 4, 5, 7, 8 is the balance. And so after that you will keep paying 10, 10, 10 percentage. That means 4. So 10 percentage of this amount is how much? Then it will behave like a normal bond. You will keep paying 457 or 458. Only interest you will keep paying. Okay, and then at maturity you will pay remaining full amount, principal amount. So it is what? Partially amortized, and then it behaves like a bond, normal bond. That is called partially amortized. Is this okay? Have you understood this one?
Yes.
So tell me, where will you end up paying more interest? In fully amortized or in partially amortized? Mhm.
Then partially amortized, we are only paying for 3 years.
In partially amortized, after, imagine partially, till here it is amortized, right? After this, you have to keep paying 457 every year till the maturity.
Okay. Like
So
until we meet the amount, right?
till the maturity, and then you have to pay the principal amount at the end. So imagine you have to pay. So imagine maturity is 5 years only. Okay. So that means next 2 years you will pay 457, 457, and then you will pay 4, 5, 7, 8. The remaining amount. Remaining is
I think
considered as
in
the
partially
principal.
we are paying more, right?
Yeah, correct. Because you are paying only the interest, right? Here, here the outstanding principal is getting reduced. So your interest is getting reduced. See, interest is getting reduced. But the moment you make it behave like a normal bond, then the principal is not getting reduced. So you have to pay more interest then. See here, you have totally paid how much? 458 and 440. If this would have been normal bond, you would have paid 458 here, as well as 458 you would have paid here as well, no? Understood or not? So in partially amortizing, you will end up paying more than fully amortized. Is it fine?
Yes, sir.
Okay. Then sinking fund provision. Sinking fund provision means it's a terminology. See, for example, imagine your company has to pay, uh, you know, 100 crore in 10 years. In 10 years, if it has to pay 100 crore, then how should it behave? It should not save any money here and suddenly 100 crore it should shell out, or every year it should keep 10, 10, 10 crores aside every year, so that at the end of 10th year 100 crore it will have and it will be easy to pay. So which one makes more sense? To keep 10
The
crore
second
aside
one.
every year. Yeah. So this is called sinking fund provision. Sinking fund is like that piggy bank. Sinking fund is that piggy bank where you are keeping some money aside every time, and then at the time of maturity you will not feel the pinch. You will be able to pay easily. Is it okay?
Yes, sir.
Yes.
And then, so sinking fund is good for the investors as well as for the company. For the investors, it gives the confidence that, okay, my money I will get back because there is sinking fund provisions. And for the investors also, they will be more disciplined rather than, shelling out 100 crores at the end. Then waterfall structure for asset-backed securities and mortgage-backed securities. Waterfall structure means how the payment will be done. Remember I said about CDO, collateralized debt obligations, senior secured bond, senior secured, secured and unsecured. Senior secured, secured and unsecured. So first, if the mortgage-backed security defaults, first whom will be paid? Senior secured, and that's why they will get less interest. Second, secured, and then third one, unsecured, will be paid, and that's why they will get maximum interest. I was speaking about this in mortgage-backed securities. Is it okay?
Yes, sir.
That is waterfall structure. That means payment of interest. So sinking fund provision, I told you. Reinvestment risk, I will speak about this because it's a very big topic. Okay, we will be seeing this ahead. After maybe couple of sessions, you will see this reinvestment risk being, I will be using this many times, this term. So basically, reinvestment risk means you are getting interest from investing in bond. Now you want to reinvest. Now imagine you are getting 10% interest. Now the interest rate in the market comes down. So when the interest rate has come down to 8%, now you got 10%. So the 10% is 100. Now when you reinvest, how much will you get? 8% only, because in the market, the prevailing interest rate is 8%. That is called reinvestment risk. Okay, the risk of getting interest and reinvesting it at the lower rate is called reinvestment risk. Okay. Then variable interest debt, floating rate note. Now what do you mean by floating rate bond? We already covered, right? Floating rate bond. Floating rate note means also, floating rate note is also bond only, but then notes means with maturity of 1 to 10 years, they are called as notes. Okay, floating rate notes means what? These are bonds only, but maturity of 1 to 10 years. Shortly, they are also called as floaters. Market reference rate, I told you some reference rate like Euribor, then SOFR, SOFR, Euribor, and then Sonia. These are some of the well-known reference rates. Basis points means what? Basis points means 100 basis points is 1%. Okay, 100 basis points is 1%. So it is like you are going into millimeter from centimeter. So when we say 1%, that can be divided into 100 basis points. 100 basis points. Normally, Reserve Bank uses this term. They will say interest rate, is brought down by 0.25%. That is equal to 25 basis points. Okay, this is basis points. Okay, so 25 basis points means what? 0.25%. 100 basis points is 1%. 50 basis points is 0.5%. Okay, so normally you will see Reserve Bank using this term 25 basis points. They will increase or decrease interest rates. That means 0.25%. Okay, 10 basis points is what? 0.10%, and 1 basis point bank uses still here. Okay, 1 basis point. Normally they don't use this one, but I'm still telling you. 1 basis point is equal to 0.01 percentage. That is equal to 0.0001. That is equal to 1 by 10,000. We will use this in economics, in forex topic. Okay, so that's why just remember this also, but then we will follow this in forex topic in economics. Whereas banks normally, Reserve Bank, central bank, they keep reducing, increasing interest rates like 25 basis points, 30, 40 basis points, 50 points, like this. Then, so 120 basis points is equivalent to 1.2 percentage. Okay, so 1 basis points is 100th of percentage. That is 1 basis points. Step up coupon bond. Okay, this is a type of bond that I missed to tell you in types of bonds. Step up coupon bond means step up coupon bonds. That means company says, I will pay you 4 percentage, next year 4.25 percentage, next year 4.5, next year 4.75, next year 5, next year 5.25, next year 5.5. So this is called step up bonds, where interest rates will keep on going up, or the coupon rate will keep on going up by a certain rate as specified in the indenture. This is step up coupon bond. Okay. Then coupon changes could also be linked to future potential events. For example, loans to borrowers of low credit quality, leveraged, often have a coupon that increases if the credit quality of the issuer decreases. Okay. So this way also, these are other innovative ways that if the company borrows more loan, then they will pay more uh, coupon also they will pay. Okay, if the credit quality of the issuer decreases, they will end up paying more coupon. Okay. A similar provision is often used in a credit linked note, whereby the coupon rate increases if the credit rating of the issuer deteriorates, or decreases if the
This is for step up coupon bonds, right? Yes.
step up coupon bonds. It is no, this is not for step up. See, step up coupon bonds are structured here. The interest rate is going up. It's a straightforward one. This one, but there are uh, other other little complicated products also. So here actually here, acha, here also you can connect. Yeah, step up coupon means here. See, what I said over here is by default it is going up, and what they have mentioned over here is this is all type of step up coupon bonds. You can say that it is based on leverage, it is based on credit link. That means if the credit worthiness of the issuer is coming down, then the coupon is going up. That way it is step up. It is connected only. What you said is right. It comes under step up coupon
So
bond.
we'll call it leverage loans, like, is it
Leverage
in
loan.
step up coupon bonds? Like,
Yeah, you may say that. Yeah.
these are types of step up coupon bonds.
So type of bonds only. These are. Remember, I said like couple of bonds I'm missing. So these are those bonds.
Payment in
Payment in
kind.
kind allows the issuer to make the coupon payment by increasing the principal amount of the outstanding bonds, especially paying the bond interest with more bonds. That means you have paid 1,000 rupees, but they will give you interest for 1,500. Okay, 1,500 or 2,000, that way. To make coupon payments by increasing the principal amount of the outstanding bonds. Essentially paying the bond with more bonds. That means for let's say This is 1000, but they will give you for 1500. So that is payment in kind. I have not practically seen such kind of bonds because there is no point complicating things. So the companies don't prefer issuing this kind of bonds as such, but they're all innovation. Okay. Green bonds. Green bond means money that is raised for the betterment of the society or environment. Example, uh, renewable energy. What will that do? That will help to reduce pollution, right? So green bond, that can be called as green bond, which will reduce carbon dioxide and all such things. Those are called green bonds. There is something called blue bonds also. Blue bond means money raised will be used for cleaning sea or marine life, bringing or making marine life better. That is blue bonds. Green bond is for the environment. Blue bonds is for the sea. Okay. Then index linked bond, that is MRR only, market reference rate. Inflation linked bond, or that Euribor, and then Sonia, and then so far, all those are index or some sort of reference rate linked one, right? Similarly, an index also can be linked. Inflation is typical one. CPI and WPI are two inflation index. Have you heard about this one, CPI and WPI? WPI is not given here. If you don't know, you should Google and read about all these things, okay? Because CPI means Consumer Price Index. This is highly used in India also. WPI and CPI is used in India. So CPI means inflation news. Have you ever read about inflation news? Just 2 days back also this inflation news came up. Did you see? If people are not reading newspaper, right? Shravani, do you?
No, sir.
So that is very bad, no? You are supposed to
No.
subscribe for newspaper. I must have told you, right? Didn't I?
Yes, sir, I will.
Then you should that to subscribe for the hard copy. Okay, soft copy if you want to do, you do. That is up to you. But certainly you should subscribe for hard copy. And every day, the first thing that you should be doing after getting up is reading newspaper. At least 15 minutes you flip pages. You don't have to read very boring news. Read whatever you like in that business newspaper. It may be about Zomato, it may be about Paytm, it may be about Bajaj Auto, it may be about whatever products you are using in your daily life. It may be something about anything. It may be about let's say the product that we normally use. Let's say Zomato or Paytm or Colgate or anything like this, Bajaj Auto, or any something about Tesla, something like this. You should put the habit. Then only when you read this kind of interesting news, you will slowly get to know some boring plus more important news as well. So if I type here inflation news India, inflation CPI, we follow CPI. See, if you keep reading this news, then neither I have to explain this CPI nor you have to struggle to understand this CPI. That is the benefit you will get. So when you don't have to struggle to understand this, automatically what? It will be putting less stress on you because you will focus on other topics. Okay, see this one. Um, it came to lower than this, 2 point something. It was 2.11 percentage. See this one. 4 days ago, India's retail inflation drops to multi-year low of 2.1 percentage in June.
So like the prices of products and services are not increasing, right? Like at
Yeah, yeah,
a
yeah,
fast rate.
yeah.
Right.
So see this one. See, now this way only you will practically relate to the news, no? Otherwise, it becomes a bookish answer if you read like this. Whereas if you connect, it becomes practical and it becomes more interesting. And remember, in the exam, you will get some question out of syllabus also possible. So be prepared. So I have seen people coming to the borderline and then getting failed. That is because they rely completely on the trainer and completely on the book. They don't go out of book, and that is very bad strategy. That's a very bad strategy. That's why when you come to the borderline where your own brain or whatever books you have studied will not help you, that time your practical knowledge, newspaper, will help you. Okay. See this importance, CPI and CPI. So if you keep reading, like if you put practice of reading all these things, it will really, really help you to think more practically. And certain questions where your book will not help you, that time your practical knowledge will help you. Okay.
Okay, sir.
I will also try to then put this kind of news in the group, but then I would really expect you all everybody, okay, to uh, read business newspaper, and you are also free to put any important news in the group, share those news, talk to your friends about those news. Okay, then only you will get more practical knowledge, and also you can ask me doubts from those articles also, whichever articles you are reading, you can put across in the group saying you have not understood this but you want to know, then I will explain it to you. Is it okay?
Yes, sir.
Then only I'm telling you, then only it will certainly help you. If you are reaching to the borderline and getting failed, then that is because practical knowledge is not there, and that practical knowledge will help you to cross the borderline. That is highly possible. Okay. Then CPI. Okay. And nowadays you have this chat GPT and all that thing, you can keep asking all these kind of questions. So then only will develop interest. Otherwise, it will become like an extension of college, and that is of no use then. Just taking a book and reading. Okay. Then interest indexed bonds, uh, capital interest indexed bonds. The coupon rate is adjusted for inflation. So what happens in interest indexed bond? Coupon rate is adjusted for inflation. That means coupon rate will keep going up as per the inflation rate. If inflation is going up, coupon also will go up. The principal is unchanged. Okay. Interest indexed bonds means what? Coupon is going up, but the principal amount is not going up. That is called interest index bond. Capital index bond means what? Capital index bond, example, TIPS. TIPS is very popular in US, Treasury Inflation Protected Securities. That means principal amount, say for example, 1,000 rupees you have paid. Let's say 1,000 rupees you have paid. So now interest it is paying 10 percentage, 10 percentage, 10 percentage. 10 percentage means let's say 100. Face value is 1,000. So it is 10 percentage of 1,000 is 100. Okay. And then principal amount is 1,000, right? Now the company will link this to the inflation rate, and then they will pay you more. So if the inflation is whatever be the inflation, if the inflation rate is 5 percentage, 5 percentage, 5 percentage, 5 percentage, so that much they will increase the amount, and then they will pay you more amount. That's why it is inflation protected. Okay, the capital is inflation protected. Okay, because otherwise, just imagine you paid 1,000 here, which you are getting after 5 years. That 1,000 will not have the same value what it was before 5 years. No, you got the difference. That 1,000 will not have the same value, right? So that's why they will make it something like, imagine this becomes 1,200. So they will, because of inflation, it is going to 1,200. Let's say I'm not calculating, just giving you a random number. So they will give you 1,200. So that means your purchasing power will not deteriorate. This is okay. Have you understood this one?
Yes.
Okay. So interest index means interest will go up. Coupon index or capital index means capital value will go up. Okay. Example is tips. So this is highly popular in US. Then zero coupon bonds we have, spoken. Deferred coupon, all that I have spoken already. the callable bond, embedded options. That means options are there. Contingency provision means actions may be taken, may not be taken. It depends upon certain conditions. That is called contingency provision. Example, we learned in derivatives. Derivative is a contingent agreement, right? Derivative means options is a contingent agreement. Okay. Forward and future is an obligation. You have to buy, you have to sell. But option is what? You have the right. If it crosses, let's say 100, then only you will buy. So will you buy or not? It is a contingent. You may buy, you may not buy. So that is called contingent provision. Okay, contingent provision. Okay. Bonds that do not have contingent provisions are called option-free bonds or straight bonds. That means no other if and but conditions in that bond. And embedded option means callable, puttable, okay, convertible. All these are embedded options. Contingent provision means where conditions are there. Based on the conditions, actions may be taken either by the issuer or by the investor. Those are all contingent provisions. If I'm going too fast, you let me know. Okay. Callable bond, I have spoken about. Then call protection. Just go through this example for a minute. Yeah, are you able to understand it?
So can you explain call protection?
Corporate action.
Call protection.
Call protection. Okay, this one. Okay. See, as an example of a call provision means callable bonds provision. Consider 6% 20-year bond issued at par on June 1, 2022, for which the indenture includes the following call schedule. Okay. 20-year bond issued at par on June 1. Okay. 6% 20-year bond issued at par on June 1. 20-year bond issued at par on June 1. At par means, are you able to understand this term at par? That means it is not issued at discount or premium, at par. At 100 rupees bond issued at 100. Okay.
Yes.
And the indenture includes the following call schedule. So they are saying it can be called after June 1, 2027. See, this is 22. So this is 20-year bond. Okay. So if I draw the timeline, you both can hear me, right?
Yes, sir.
So it's a 20-year bond. So it's a 20-year bond and starting with 2022. So this is 2022 and it is going to 2032. Uh, okay, now 2027 is somewhere here, and then 2020, 2030, and 2032. So it can be called here 1st June, 1st June here, or 1st June here, 2030, or uh, after 2032 also. So okay, actually this is 20-year now. So 20-year means 2022 plus 20, 2042. So the maturity period is 2042. Okay. Now after 5-year period from the issue date until 2027, that means from the issue date 2027. Acha, this is 5 years. In this 5 years, the bond is not callable. Hence, we say the bond has 5 years of call protection. Okay, 5 years of call protection.
So like for the first 5 years, the company does not have the right to
Call
call,
back.
right?
So this is call protection, protected from using callable provision.
And the investor can sell if he wants, right?
They can sell anytime, provided if it is listed, they can sell anytime. Yeah, if there is liquidity and if it is listed, they can sell. Like in country like India and all, it is difficult to sell. Okay. Like I invested in one bond many years back, and I think it was Karnataka Bank, something. Many companies I invested in, so I think it was couple of, I think Karnataka Bank one. So they were paying me good interest rate, 10 or 11% something they were paying, and for 4 5 years I got that interest, but the maturity period was very like uh, far away it was, and then as per the when the callable date came, then they called back and then they repaid the principal amount back to me. Okay, so utilized. Why so? Because they were paying me very high interest rates.
So like that was risky, right?
Yeah, risky only. It was unsecured bond. It was unsecured, but it was a bank, and that time I invested. Now I will not into any unsecured one. Now I prefer equities more. But that
Okay.
time I invested, but that was like it had callable provisions, and accordingly they called back. That means they paid back the premium before the maturity. Exactly on the callable date that was mentioned, they paid. Okay. So this is called first call date, second call date, third call date. So the risk that the investors are facing, that is called as call risk, that the company can call back. Okay. Then puttable bonds also we have discussed, convertible bonds. Conversion price we have not discussed. This part we should discuss, right? conversion price, this is the par amount per share at which the bond may be converted to common stock. Conversion ratio and conversion value. So conversion price means, imagine one bond can be converted at the rate of, let's say at the rate of 50 rupees, okay, or 100. One bond can be converted at the rate of 100 rupees. So that is the conversion price. Conversion price. One bond can be converted at the rate of 100 rupees. This is the par amount per share at which the bond may be converted to common stock. Conversion ratio. This is equal to the par value of the bond divided by the conversion price. If your bond with $1,000 par value has a conversion price of 40, its conversion ratio is 25. Are you able to understand conversion ratio? That means par value of 1,000 and the conversion price is, okay, let's take this example only. Let me not take 100. So here, if it is 40 rupees and the bond is 1,000, okay, so when you convert, how many equities can you create out of this? So with 40 you can get 1. So with 1,000 rupees bond you will get 1,000 divided by 40. That is equal to how much? 1,000 divided by 40 is 25 per share, per bond. Conversion value. This is the market value of the shares that would be received upon conversion. A bond with a conversion ratio of 25, this one, when the current market price of a common share is 50, would have a conversion value of 1250. See, that means now this is at the rate at which you are converting. Now imagine actual market price in the market is 50 rupees, but you are converting at the rate of 40. So for 40 you will get 1. So for 1,000 rupees, how many will you get? You will get 25 per bond. So 25 per bond, and you got 50 in the market. It is 50. So in the market it is 50. So 25 into 50, 1250. You invested how much? 1,000, and you are getting 1250 value. That is called conversion value. Have you understood this one? Conversion value.
It is the profit that we are calculating, right?
Yes, yes. So I'll repeat this again. See, they may convert it in the form of price or in the form of ratio. So if now if it is in the form of ratio, they will say like one bond can be converted into uh, let's say one bond can be converted, in this case one bond can be converted into 25 shares. One bond can be converted into 25 shares. So that means 1,000 rupees you invested to buy this one bond, which is getting converted into 25 shares. That means what is the conversion ratio? Conversion ratio is 1,000 divided by 25, that is equal to 40. That means 1,000 divided by 20. So sorry, not 25, it is 40. Wait 1 minute. Just hold on 1 minute. Conversion ratio If one bond is getting converted, if one bond is converted into 25 shares, that means you are getting per share at the rate of 40. Okay, I'll repeat again. If one bond you can convert it into 25 shares, that means if one bond can be converted into 25 shares, that means 1000 rupees is getting converted into 25 shares. That means one share's price comes to 40 rupees. Now imagine in the market, if it is 50 rupees, then you will actually convert and you will be rewarded. Okay. If it is lower than 40, you will not convert. Is it okay? Have you understood or not this one?
Yes, I understood.
Yes.
Then conversion value means whatever number of shares you have converted to into the actual share price. Okay. Conversion ratio means par value of the bond divided by the conversion price. Conversion price means at the price at which. So here uh, they have mentioned the price as 40. So at the rate of 40 you can convert. So at the rate of 40, when you convert, you get 25 shares. When you get 25 shares, in the market it is trading at 50 per share. So you multiply, you will get 1250. Okay. Then warrant. Warrant is warrant means what? See, what are the ways through which a company can raise capital? One is through equity. Okay. One is through equities. One is through equity. One is through bond. Okay. One is through bond. Then, so this bond is what? Borrowing. And this equity is shares, giving shares, ownership. Giving ownership, and they are raising capital. And here they are giving interest and they are raising capital. Now, what is preference shares doing in between? And then warrants. These are different ways for them to raise capital. A warrant. See, uh, equity is the, out of all these things, tell me which is the most expensive uh, uh, way to raise capital for the company. Out of all this, the most expensive one is
Yeah.
equities.
Equity.
Equities. Okay. And now let's see what happens here. Bond, in bond, their bond is loan 10 percentage. Let's say here generally 15
And
percentage, here
there is no share of
10
ownership
percentage.
in
Huh?
like in all of these, right? Except equity.
Yeah. Now in warrant they will get later stage. We will speak about it. See why preference shares came into existence first of all. And what is preference shares doing? Preference shares is, under preference shares, what am I saying? I will give fixed dividend rate, which is similar to coupon only. Na? Then why am I doing all these things? I'm paying fixed dividend rate. So why preference shares came into existence? The problem is when I keep issuing more and more debt, my debt to equity ratio goes up. So in my balance sheet, what happens? There is more debt. Okay, and this is deteriorating the quality of my balance sheet. Okay, it is deteriorating the quality of my balance sheet. So I'm worried now what to do. Okay, but I want to borrow more. So in such situation, what will I do? I will go to the market and say I'm issuing preference shares. Normally, preference shares can be issued to the insiders, maybe issued to the outsiders also. Insiders as in directors, promoters, all these people. Okay, it may be issued to the outsider also, not necessary. So now in preference shares, okay, in preference shares, the company says, company, what happens, preference shares, it is structured as share. So when it's structured as share, that means if I'm issuing more preference shares, my debt to equity is not getting impacted because it is not a debt. It is not considered as a debt. So because it is not considered as a debt, so I'm happy to issue preference shares. Then why am I not issuing it every time? Reason being, it is more expensive than bond. So for preference shares, if it is for bonds, if it is 10%, for preference shares, it will be 12%. So that means they are getting this benefit, but then it is coming with a cost. So that's why companies will not prefer preference shares, okay, or they will not prefer preference shares more than bond. Their first preference will be bond only. But in case if they have issued bonds very highly, if the debt is already very high, then only they will go for preference shares. Have you understood the logic why preference shares? It is just kind of cosmetic, applied so that the balance sheet looks better. Is it okay?
Yes, sir.
Now, what is warrant? Warrant means company is in a very bad shape now. It is not able to pay interest, not able to pay fixed dividend rate also. But still it needs money. So what to do now? So what to do when they cannot pay anything, then who will trust them? Okay, and imagine the market is not trusting them also. So, but they are thinking what to do. But see, who knows about the company best? The management, the directors, the promoters. Now the directors and promoters are thinking, look, the market is not trusting us. But we know that in the next 3 years, our company will be extremely good. So what to do? So that time they will issue warrant to them only. Okay, company will normally, generally, warrant will be issued to the insiders. Generally, it is issued to the insiders. Okay, so under warrant, what will happen? Imagine it's a 3-year warrant. Now, in 3 years, they will bring in capital. Insiders, here, this promoter and directors will bring in capital, but they will not get anything in return. No interest, no interest, no interest. Now the question is then why are they bringing in capital? So why reason being after 3 years, okay, this is just example I'm giving. After 3 years, they will have the right to convert their warrant into equities. So in the next 3 years, if they really do well, imagine per warrant is 50 rupees. Per warrant is 50 rupees. If per warrant is 50 rupees, if per warrant is 50 rupees, and imagine they have the right to convert it into equity, 1:1. One warrant can be converted into one equity. So they know right now equities price, is somewhere around 70 rupees. Now in the next, somewhere around 70 rupees. So now in the next 3 years, it will cross maybe like, 150 rupees, it will cross. Beyond 150, it is crossing. So that time when they will convert it into equity, they will reap huge amount of benefit. Or 100 is also enough.
There's no
100.
interest
So
in
when
all
it
that.
crosses 100, these investors or these insiders will get huge profits, right? They invested 70, they are getting 100.
There's no interest in all that, not anything.
No, they don't pay interest. Okay, so
So like
warrants are also
how do they
called as
predict?
long dated options. Okay, long dated options. Why long dated options? What did we learn in what did we learn in
Derivatives,
options?
call
Options means
options.
what? Yeah, options means what? You have the right to buy. So here long dated means what? It is valid for, here also you have the right to buy, right? You have the right to buy equities. exchange your warrant for equities. But and also you have to wait, but you have to wait for longer period. That's why it is called long dated options. Is it okay?
Yes. So there's like a lot of risk in here, right? Because they'll have to predict what will happen after
That's why
3 days.
outsiders generally will not invest in warrants. So it is the investors who knows about the company, they tend to invest.
Okay.
So this is another way for a company to raise capital. Okay, so now when I say warrant like this, what you should do at home is you should Google more about this. Like, is there any company which practically issued warrant? Then try to read more about them. Or anything, any terminology that I'm giving, don't restrict your knowledge to only this training. Then it's a bad strategy. Okay, that's why speak about all these things to your friends, learn from your friends. If they are not listening, then better change your friends. Okay, that is good only for your career. Okay, and you can also listen to them if they are speaking, something about career oriented, something about this market news, business news, all such things. You can also listen to them. So that's why learn from everywhere. uh, then only your learning curve will go up. Otherwise, if you be dependent only on me or only on this session, then to a very large extent you will succeed, very large extent, but you never know, you might come to the border and get failed. That is possible. Okay. So this is warrant. So you should learn from Google, learn from ChatGPT, and whatever knowledge you are getting from ChatGPT also share it with your friends. Okay. And encourage others also to communicate about finance with you, to communicate about business news with you. Okay, this one. This is okay now. Then
Yes.
contingent
Yes.
convertible bonds. Contingent convertible bond means what? uh, yeah, COCO, called as COCOs, are bonds that convert from debt to common equity automatically if a specific event occurs. So from bond, automatically it will be converted into equity. This type of bond has been issued by some European banks. Banks must maintain specific level of equity financing. If your bank's equity falls, see the condition. If your bank's equity falls below the required level, they must somehow raise more equity financing to comply. COCOs are often structured so that if the bank's equity capital fall below a given level, they are automatically converted. See what happens, in banks, they have to maintain certain something called as capital adequacy ratio. Okay, capital adequacy ratio. That means minimum this much of capital they have to maintain. Like normally it is around 10 percentage around or so. Okay, adequacy. Okay. Adequacy ratio. That means, see, how are how are banks getting money? Through us, we are only depositing money, correct? So does that mean, and they are lending that money? So what if when they are lending that money, what if the borrower turns out to be some sort of fraud and he did not pay? Then we are the savers. Banks is there in between. So can the bank say to us that, look, your money is gone, I gave it to somebody and he is not returning? Will we accept that one? Depositors will not accept, correct?
No.
Have you understood or not this story? We will not accept. So that means apart from us also, there are equity holders as well in the bank. Who will take this risk? So that risk will be borne by the equity holders. So that's why the central bank says that, apart from depositors, you should have more and more equity holders. So if you have 100 rupees with you, 100 rupees, out of that, say for example, 10 rupees has to come from the equity. Remaining 90 is coming from the depositors. That is fine. But 10 rupees has to come from the equity minimum. Let's say I'm giving an example, okay? Capital adequacy. I think I don't recollect the exact number, it is between 8 to 11% somewhere around. So I'm just giving you roughly 10%. So um, yeah, so but then if it is coming down, imagine they don't have that much of capital. So then automatically, then this COCO will help them. This bond will be converted into equities. So that is called COCO, means contingent convertible bond. Okay. Now how you should prepare is, it says some European bank. Then you should Google European bank that issued contingent convertible bonds. Then take that article, put it in the group, share that knowledge. So try to extend your information rather than just relying on the book. Now this book is not saying which European bank, but you can
Just
search.
now, here the interest rates would be high, right?
Huh?
The interest rates would be high, like the coupon
Higher. Yeah. It will be
high.
higher. Yeah. Okay. So you should have the curiosity to check which would be that bank, and then once you get that bank name, put it in the group. Okay. Domestic bonds means domestic normal bonds within the country. Foreign bonds. Foreign bonds means international one. UK company raising US dollar to expand their US operations. So that is foreign normal one. Euro bonds we discussed. Euro bond is also called global bonds. Euro bonds that trade in at least one domestic bond market and in the Euro bond market are referred as global bonds. Issued outside the jurisdiction of one country and can be issued in any currency. Less regulations. Bearer bonds, I told you, right? Bearer bonds, like currency. Whereas, like Euro bonds, today Euro bonds, like most other bonds, are issued. Today, nowadays, it is issued in registered bonds also. But what did I say? Most Euro bonds are bearer bonds. But now they are being issued as a registered bond also. Okay, they are being issued as a registered bond as well. Okay. Then Euro bonds, foreign bonds, global bonds, Euro bonds are collectively called international bonds. Then Sukuk bonds. Sukuk bonds are Sharia compliant bonds. Okay, Sharia compliant bonds with specific restrictions on the payment of interest rates. So they follow Islamic law. Okay, so their interest is not acceptable. So without using interest, they tend to deal with bonds. Okay, so these bonds, this periodic cash flows, you know uh, instead of using interest, they use rent. Okay, they call this as rent. Okay, for example, imagine normally if you are taking a home loan, what will you do? You will keep paying interest to the bank, correct? But there, how it works is, the bank will take the ownership of the home. Okay, and so this is the home. So you are not buying, bank is buying, and then this bank will give it on rent to the actual one who is interested in the home. So this guy will keep paying rent instead of paying interest. This guy will keep paying rent instead of paying interest, and then there will be an agreement that he will stay in that home for the next, let's say, 30 years. And then once he repays all the rent for 30 years, then this home will be transferred to this guy's home, to this guy's name. Okay, so instead of paying interest, what is he paying now? Rent. Have you understood this one?
Yes, sir.
Okay. Then original discount bond means this is zero coupon bond only. Zero coupon bonds. So you read all this and then go through this questions, okay? Then read the key concepts also. That key concepts also a good summary. And as much as possible, what I normally suggest people is like you create your own summary of the readings or summary of the subject. More and more you put effort without expecting ready-made notes, you will improve better, even if your notes are not perfect. So create summary on your own, and if you think that it is okay, you can even put up in LinkedIn. Like this, you have to spread across your knowledge. You will be able to retain those knowledge better. More you spread those knowledge with others, more you will retain. Okay, fixed income issuance and trading. Yeah, so this one, I think still we have not started with the sum. Maybe after some time it should come. Bond issuer are government bonds, corporate bonds, special purpose entity, asset backed securities. Credit quality. Okay, credit quality means what? So there are credit rating agencies. Like for movies are rated, right? 5-star movies means what? Super hit movie. 1-star movies means flop movie. Similarly, here also ratings are given. Triple A, double A, triple A. Like this, ratings are provided. Okay. Triple A, double A, single A, triple B. This kind of ratings are provided. Okay. Now bonds with double B and below. These are junk bond. Junk bond means what? Non-investment grade bonds. Non-investment grade bonds. And these are called investment grade bonds. That means good to invest. Investment grade bonds. Is it okay? These are ratings. And yeah, junk bond is also called high yield bonds. Why high yield bonds? Because these are all junk. So who will invest in junk? Only if you pay high yield, then people will invest in junk, right? Okay, so that's why positively we can call that as high yield bond. Like positively, you can say this is junk food. Now that doesn't sound good. So what can you say? Tasty food, then they are tasty also, correct? So very tasty food is what? Junk as well. Positively, you can say they are making it very quickly. Quick, what is that called? Quick commerce, something, right? Quick restaurants. So that is a positive
Okay.
name. Otherwise, what is that? Junk. A
Fast
junk
food. Fast
restaurant,
food.
right? Fast food. Okay, that is a positive way to say fast food. Otherwise, it is a junk food, no? Okay. Understood this one? See here, uh, default to free treasury bills. We have spoken right about treasury bills and investment grade repo. Why repo? Commercial paper. So commercial papers are unsecured. Now I said commercial papers are unsecured. Now you should again Google which company issued commercial paper. Last time I showed you mutual funds, right? You can Google and you will get to know other companies also. Okay. So investment. So only good rated companies for them only lenders will be lending money. Okay. ABCP means asset-backed commercial paper are also there. That means in a way secured asset-backed. Now theoretically commercial papers are unsecured. Okay, you have to go by unsecured only. Okay. If it is secured, it becomes repo and reverse repo actually. Now here, if you see, normally people ask this question: how come investment grade bonds, unsecured corporate bonds, it is coming under? Okay, and high yield bond, secured corporate bond. How is it possible? They say. You understood the question? If it is an
Yeah.
investment grade company, then why is it issuing unsecured corporate bonds? It is a good company, and this high yield means what? Bad companies issuing secured corporate
They
bonds.
can have various types of issues, right?
Yeah,
That
but
shouldn't be a
then
problem.
but then see, when you are a very good company, you don't want to keep giving collateral. You will say, I'm giving unsecured corporate bond. If you want, you invest. You understood the
But that
connection?
too would be safe because like they have a good reputation and so
Reputation.
on.
So they don't want to keep collateral and all those things. Whereas high yield bond, which are not safe, they tend to provide more safety because they have to provide. Otherwise, nobody will buy. You understood? Normally, people get this doubt like actually it should be investment grade should come under secured corporate bonds. Why unsecured? Because they are investment grade, they tend to issue unsecured. Then fallen angels, that means whose credit quality has come down highly, they are called fallen angels. Just a phrase. Then syndicate of banks. Syndicate means group of banks offering credit facilities. So here what happens is sometimes a company wants to, imagine a company wants to take a loan for a huge amount. So there is one company which comes to a bank and it is asking for a huge amount, 1,000 crore. Now the bank knows that 1,000 crore is a huge risk, but if it gives, it is very good if the company pays back. But what if the company doesn't pay? So what it does is it wants to diversify the risk. So it will act as the agent and it will approach other banks. Bank 1, Bank 2, Bank 3, and Bank 4. This is called what? Syndication. Syndicate means group. Okay. For offering credit facilities or loans. Okay.
Also insurance, right? While providing insurance,
Huh? Huh?
like like when the insurance amount is too big, that time also they form syndicate, right?
Huh? Huh? Yeah. That time also possible. Yeah. Okay. Then investor positioning in credit maturity spectrum. Default free. Okay. So within 1 year, uh, investor invest in within 1 year default risk free. Money market they tend to invest. Money markets all what they tend to invest in less than 1 year bond, right?
Short-term funds.
Then it is 1 to 10 years. Hedge funds they are all risk takers. Hedge funds, distressed debt funds, they invest in all heavy risky instruments. These are all safe players. Pension funds, insurance for long term also they want to play safe as well. So they invest in investment grade. Okay, this is just a table only. Yeah, you can read this part as a okay information, but self-explanatory only, easy only. Different types of fixed income indexes. Uh, Aggregate index. An example of an aggregate index is Bloomberg Barclays aggregate index. which includes index from all sectors across 28 currencies. The index excludes high yield and unrated bonds. That means risky bonds they will exclude, and bonds that do not meet minimum size for inclusion. This bonds was into news, few months back. Bloomberg Barclays, that our country's bonds also are getting included in it. So again, you may Google Bloomberg Barclays Aggregate Index, Economic Times, or Business Standard. You type like this, you will get some article. Then you read. That way, if you prepare, you will never forget. Okay. Then see JP Morgan Emerging Market Index Plus. So what do? They are aggregating index, other index. Okay. And then they are becoming one aggregate index. Bloomberg Barclays Aggregate Index, JP Morgan Emerging Market Bond Index. Then, yeah, these are some examples. Then MSCI, Bloomberg Barclays MSCI Index, these kind of various indices are there. This is all for your information. What you can read here is, these points you may read. Index offers differ from equity index in the following ways, and this is a good point to read. Corporate bond issuers can and often do have many different bonds outstanding, while they will likely just go through this, see if you are able to understand these 3 points.
So can you explain the last three lines
Last
of the first point?
first two
Consequently,
points,
bond
last
tracker
3.
points. Yeah.
Okay, corporate bond issuers have many different bonds outstanding, while they will likely have no more than 2 or 3 different classes of shares. That means equity shares, equities also, there can be different classes, class 1, class 2 equities. Okay, class 1, class 2, or class A, class B. What do you mean by this class A, class B? Here they will get voting rights, and here no voting rights. Okay. So in India, we call that as differential voting rights, DVR. Differential voting rights. For the same company.
Like Tata Motors DVR.
Correct. Some companies will, some shareholders, they will get voting rights. Another one, they will not get voting rights. So if you go to some, this broking firm app, and if you type DVR, differential voting rights, you will be able to see. Let me see if I can show it to you.
So can you switch to the PDF?
Huh?
The PDF.
What PDF?
Like, can you switch it to the PDF?
Sure. These are some companies. I just searched with DVR, GACM Technologies DVR. So this Tata Motors DVR ordinary. So DVR means their voting rights will be different than the ordinary shares. Okay, voting rights will be different from the ordinary shares. Acha. Now the question was that different classes of shares. Even in foreign, in US, it is quite popular. Like Berkshire Hathaway, such kind of companies, they will have differential voting rights. This leads to fixed income index having many more constituents than equity. That means equity is divided into two parts here, classes, two or three. Whereas bonds, there are plenty of bonds. No? One company can keep issuing plenty and plenty of bonds. Okay, then equity index. Consequently, broader bond tracker funds employ sampling technique rather than purchasing all the constituents of fixed income index to keep traction complexity reasonable. So they are picking samples. So employ sampling technique. Like if you see Muthoot Finance, after every few months it keeps issuing bonds. Muthoot Finance. So now, if you are including Muthoot Finance, then how will you track it? Because it has given loads of uh, loads and loads of this um bonds. So they have some sampling technique to uh, track that company's bonds price rather than taking all the bonds. Okay. Rest is fine.
Second one, they're saying that they keep on add and removing, adding
Yeah,
and removing.
because bonds will have maturity date also, right?
Hmm.
Equity do not have maturity date. Bonds will have maturity date. Then you have to remove that one. Okay, removal and replacement, right? Because bonds
And
will
the
have
third
maturity.
one says that like the credit quality would also affect the index rates, right?
Yeah, yeah.
Okay.
Okay. I think it's already 10:30 now. Let's see where should we stop now. Yeah, I think it is good only. We can begin from primary market next time. Acha, otherwise, still some theories pending. Okay, then we'll stop now here only. We'll begin from primary market next time. But please, you read it and don't restrict your knowledge only to this book. That is not a good strategy. Google, use ChatGPT, type whatever terminologies you want in Google and just suffix with economic times. You will get many articles. Read all. Subscribe to newspaper. If you find any relevant news relevant to what we are doing, take the screenshot, put it in the group. So this kind of personality you have to develop. Okay, not just a bookish person. Fine. Okay, we'll stop now.
Okay, sir. Thank you,
Thank
sir.
you.